Am I going to be buying SLTY, the newest weekly paying dividend ETF by YieldMax? We're going to touch on that in this video. I'm very excited for this fund. There's a lot to talk about. I'm not going to overhype it. I want to give you a full rundown on what I thought and some of the key points from the interview I did with two YieldMax ETF professionals just a couple of days ago. That video will be coming very, very soon. If you guys don't know who I am, my name is Spencer and I talk all about income investing with ETFs. So don't forget, if you're interested in weekly income, in monthly income, in dividends, to like and subscribe. That way you won't miss out on all the free content and you'll know what income ETF investors are looking at. Let's roll that intro. I have been tracking the weekly dividend ETFs for a very long time. I have years of data I've collected from my own purchases of these ETFs, watching how they pay out and how they perform in the different markets. Now, SLTY is super unique, just like SLTY is very unique. I mean, maybe YieldMax is kind of similar, but these strategies are the same but inverse. And I'm going to try to explain this in a really easy to understand way, because I don't think SLTY is too complicated if you really do understand SLTY. But the problem is if you don't fully understand it, it might get a little bit tricky. And I will say I had a little bit of a look under the hood, as you would say, with SLTY, because I interviewed those YieldMax executives, and it was a really good time. They gave me a lot of insight into SLTY, how it works, and that interview will be coming out tomorrow for those that are interested. I have to edit it, and that's it. But it's a long interview. I had a lot of good questions. You guys gave me a bunch of questions, so thank you very much. They love the questions as well. Now, SLTY is SLTY, but inverse. And so I'm not going to go through all the boilerplate language. It's a high degree of risk. And I'm going to be honest, I don't buy these right off the bat, especially for my Roth IRA. I might buy them early on for YouTube, but I only invest $100 into each of them when I buy them for YouTube. So I'm not just going crazy and buying this immediately. But you also will have a cap on potential gains, same thing. And it's also the main goal is income. Fund overview, investment objective is similar. The only difference with this one and SLTY is inverse exposure. And that's key. So like I said, SLTY is not holding the same underlyings as SLTY. It's not how it works. The way SLTY works, SLTY, not SLTY, the way SLTY works is they're taking these high implied volatility stocks that have crazy upward trajectory, that are just really insane. So you'll see a lot of big names in there depending on what's moving in the market, and they shift them out. I think they shift it out either weekly or monthly. I can't remember which, but it's basically they're funneling into all these stocks for the most high implied volatility to make the most on premiums, but hopefully get a little bit of upside potential. And I will say, I asked about the SLTY strategy switch. I'm not going to tell you. You got to watch the interview. I'll have timestamps if you guys want to see just directly that. But it was very interesting. It was very interesting to say the least. Now, for SLTY, you want all those things to have upward momentum because you'll get some of that price appreciation with the new strategies they're using, right? But for SLTY, you want the opposite. So what SLTY is doing is they're buying securities, and we'll take a look at those. We'll also take a look at the prospectus and, of course, the holdings. But you want them to have a downward trajectory because it's an inverse. So even here, they're going to say that you are capped with exposure. And here it says cap participation in potential price declines, because you're expecting the holdings to drop in SLTY, not in SLTY. So that is a difference, but we are inverted. Where's inverted? It's got to be on here somewhere. It's on here somewhere. Because we're inverted, we don't want them going up. We want them going down. And I think people might misunderstand that, or they might think that owning SLTY is a complete hedge to SLTY when it's not. The cool thing with both of these, though, is that SLTY you can use in a green market. SLTY you can use in a green market. It is not necessarily a fund you have to wait for a red market to hold. All you need is stocks that are dropping. And if you don't know, there are stocks absolutely tanking almost every single day. If you want to know, look at my portfolio. I'm just kidding. Some of them, I'm not going to get into it. But we have stocks that have implied volatility that are falling rapidly, whether it be on earnings, on who knows what, tanking. And so SLTY can still be utilized in a green market. Same with SLTY in a red, although usually maybe we see some fall on the NAV. It depends on the payouts, and I'm not sure what the dividend yield is going to be for SLTY. We will have to wait and see. But I am really curious what you guys are thinking about this fund. So based off that, let me know in the comments. Are you thinking about buying? Would you hold? Is this something you're even interested in? I have been doing a lot of content on the weekly payers and some, zero NAV erosion style funds, but I like going back and forth, and the weeklies are so entertaining. Now, keep moving. Here we go. So Salty itself is unique, but kind of similar to Ulti. And I think those two are very different. But what's going to happen is in a bear market, Salty should still do fine. It really does depend how the fund managers are going to manage this one. And I will say that goes for almost all the YieldMax funds, almost all funds in general. What we're waiting on is to figure out how this strategy works and how the fund managers or strategists utilize it, because that's what makes these funds perform. I would say 50% the strategists running the options and 50% the underlying performance, because they're trying to anticipate what's going to happen, but sometimes the market, as you guys know, I'm sure, does the opposite of what we are expecting. So that was kind of a long-winded expression, but I hope that was a good breakdown on Salty and how it's different from Ulti. Let me give you a little bit of a wrap up. Ulti, high implied volatility stocks that are going up. You're going to get some of that upside and the high premiums. Salty, inverted funds, an inverted position on funds that are going down, meaning the fund goes down, we make money. The fund goes up, we lose money. And at the same time, high implied volatility to harvest those juicy premiums and make a lot of weekly dividends. So if you have questions, if that didn't make a lot of sense, drop them in the comments. And what we're going to do now, we're going to look just through one section of the prospectus. I know the prospectuses can be boring, but if you are going to be an active ETF investor, you have to read, all right? You have to read them. You have to know what you're investing in, especially if you're investing for the long term. So let's check it out. Starting off on the prospectus, we're going to jump to page 4, which is the equity strategy page. And I recommend, again, go through the prospectus. I know you don't want to. I didn't want to either. I actually did, because I'm getting better at reading these. And you will see that. I've read hundreds of these now. You will see that you get better at understanding what they're talking about. I'm still not perfect, but we can see the way that they're going to hold the underlying securities. So they can gain short exposure to the underlying securities directly or synthetically through options, through different options. You have the direct, where it may short the underlying security when the advisor determines a direct short is more cost effective. Again, relying heavily on the advisor and what they believe. And I've never shorted something specifically. I have never really liked the short funds either, like purchasing a fund that's going to short something. But I do think this is a cool way of doing it. So they still have that option, gives them a little bit more freedom. Now, the synthetic, this is, I read this like 5 times and it's still, I don't know if it's the wording or if it's my brain being slow, maybe a mix of both. But synthetic, to achieve a synthetic short exposure to an underlying security, the fund will buy that underlying security's put options and simultaneously sell that underlying security's call options to try to replicate the inverse price movements of owning that underlying security. I also want to say, I've totally forgot. The fund management fee, this is key. 1.24% gross expense ratio, less than Ulti, which is interesting. Don't know why, but it's cheaper, so I can't complain. So you have 2 ways of directly being impacted by the movement of the underlyings, where you're either going to be directly shorting it or synthetically shorting it and trying to replicate, which sounds harder to do just based off reading this, the price movements. I should say the inverse price movements. And so what I'm thinking, I always thought, oh, I don't mess with with winter, with crash, with any of these tickers that are, you know, the short positions of these. Even if we are in like a bear market, I usually just hold and reinvest dividends depending on what I'm looking at. But this sounds like a completely different way of doing things, which I think is really, really cool. I think it's a great idea. I'm going to say that. I am not pumping this ETF up. I'm going to get comments on pumping it up. I'm not. I think it's really cool that they took the Ulti strategy, swapped it in a way, and now it's a functional bear case for stocks that we think are going to continue to fall downward. And so I think that's really cool. Whether or not you want to buy or hold any of these funds, any YieldMax funds in general, it's cool that they are working on this and that they're kind of pushing different strategies around. I think it's a great idea. I really do. So they have all this. You can read more into the synthetic strategies, learn more. I definitely will recommend it. But now let's look at the funds they're holding, aka stocks that they believe are going to go down. One thing that I'm not sure of is how the holdings work currently. I don't know, because it shows negative signs. I'm not sure if that's a sell. I think it just means that they are holding. I don't know, but let's look at the tickers. That's what matters. So they have the treasury bills, yada, 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 whatever they do with cash as well. And I think this is different because it is an inverse. We have Asteria Labs, which is a very high implied volatility stock. I know this because it was in SLTY for a bit, I believe. We have ANF, Abercrombie, and Fitch, which is very interesting. I used to wear all their shirts in junior high. I was looking so fly. It was a good time. All right. I don't have them now. I don't wear them now. Maybe I should. Maybe they're on sale because the stock is doing poorly. We have Applied Digital Corp. We have Bloom Energy, Bill Holdings, Circle Internet Group, CrowdStrike. They think CrowdStrike's going down. I hold CrowdStrike. That's kind of a bummer. Let's hope that they're wrong. Fingers crossed. I'm a huge cybersecurity fan. I'm just going to say it. Dell, I believe I had a Dell computer and it was not good. Enphase Energy, kind of an interesting one. We have Lululemon, we have Mara, and MSTR. So some of these are going to be in here just because of the high implied volatility. I'm not sure how that works when they're formatting these. If they're directly thinking, oh, Salty, I want the stock to go down, or if they're just putting these in here as well because they are such a high implied volatility that they could go up more or go down more. And it's not even a selection by the advisors or strategists, because Robinhood as well. Robinhood has gone on an insane tear upwards. It only makes sense for it to be thinking of going down, but PLTR kind of tricked us and went from 160 to what? 180, and then pulled back to 160, and it was like, gotcha. And then we have Ulta, which is I think the makeup brand or something like that. So again, 15 to 30 holdings, very interesting way of doing this. So what we're going to do now, real quick, we'll look at the chart so far. Not a lot of trading, but I'm curious how it's doing. It's been trading since August 22nd, and we've seen it fall 2.92% in that time. Not bad. Nothing to really complain about. We've seen some take some crazy dives. So I'm not upset by that at all. Now, there is one thing that's very important to note. This ETF is $48.50. That's a lot. It is not the same price as SLTY. I'm not sure how they decide what the price is going to be. The price doesn't matter as much when it comes to these income ETFs, but I like the fact that I can hold a lot more shares of SLTY, get those dividends, reinvest, buy more shares, and so on and so forth. Now, does it really have a direct impact? Not so much. It's more of a mental thing for me. I just like that it is so cheap. And for those that can't buy fractional shares on some of these, or maybe your broker doesn't allow it, I will say I've been talking with Moo on getting all the fractional shares figured out. So fingers crossed that comes very, very soon. But now, Salty versus SLTY. Very interesting use case for both. I think there's a place in a portfolio for both of these. Maybe I'll have to do some update videos on how they're performing against each other, how the dividends are. I'm expecting Salty's dividends to be significantly more than 10 cents as it is a near $50 ETF, but we will hope. Time will tell, and we should find out very, very soon. But as always, do your own due diligence. This is not financial advice, and I hope you guys did enjoy this video. I hope you learned something. I had a lot of fun talking with YieldMax about this ETF, and again, that video will be coming out tomorrow. So I hope you guys are looking forward to it. Tons of great stuff on SLTY, on all the YieldMax funds. We talked about a bunch of stuff, so I really think you guys will enjoy it, and it was definitely a pleasant conversation. But that's the end of the video. Thank you so much. If you like this video, you're going to like these popping up on your screen right now, including 9 income ETFs with 0 NAV erosion. So if you ever want to retire, check those out. Thanks again, like and subscribe, and I hope to see you in the next video.